Welcome back to the channel. Today we are breaking down SanDisk and answering the one question everyone is asking: why did this stock rebound so violently from the crash? We are going to look past the short-term summer volatility and show you why this is no longer a cyclical memory play, but a high-margin, highly predictable AI infrastructure utility. If you have been hunting for a real math-backed buy-the-dip opportunity in tech, this could be the one you cannot afford to miss. Before we dive in, if you find this breakdown valuable, do me a quick favor and tap that like button and hit subscribe. It genuinely helps the channel grow and takes you less than 2 seconds. Now, let's get into it. But to understand why this opportunity is so unique, we first have to look at the massive valuation disconnect that is hiding in plain sight. Right now, the broader technology sector is trading at a premium median forward price-to-earnings multiple of 20.9 times. Yet SanDisk, despite growing its revenue at triple-digit speeds, is trading at a forward price-to-earnings of just 7.31 times. Why on earth would that happen? Because the market is still treating SanDisk like a cyclical hardware company that rises and falls with spot market memory prices. But here is the thing that most investors have completely missed: that old narrative is now completely dead. By shifting to a brand new business model backed by multi-year fixed-price contracts, SanDisk has locked in a $93.9 billion revenue floor. Combine that with a board of directors sitting on $15.5 billion of immediate buyback dry powder, and what you have is a coiled spring waiting to release. So how did a company with these kinds of predictable metrics end up discounted by over 60% compared to its peers? To answer that, we have to look at the structural paradigm shift happening under the surface. In the past, investing in SanDisk was a wild roller coaster. You bought when memory prices were low, you prayed for a supply shortage, and you sold before the inevitable crash. But in 2026, the reality is entirely different. SanDisk has systematically replaced spot market volatility with long-term non-blocking contracts. They have transitioned from a commodity hardware supplier into a mission-critical provider of AI latency infrastructure. Instead of low-margin cyclical hardware, they are now targeting sustained 80% gross margins and 75% operating margins. And instead of hoarding cash to build speculative factories, they have committed to a 100% excess cash return policy to reward their shareholders. This is a completely different company than it was just 18 months ago. And yet, despite this beautiful business model, the stock recently went through a summer of absolute chaos that shook out every weak hand in the market. Let me trace the timeline for you, because honestly, it reads like a financial thriller. In late June, SNDK was the absolute darling of the S&P 500, peaking at an all-time high of $2,354 after an 857% year-to-date run. Its relative strength index hit a legendary 99, making it mathematically the most overbought stock in the entire world. Then came July. A massive leverage unwind forced Leopold Aschenbrenner's hedge fund, Situational Awareness, right to the brink of total collapse under a $5.6 billion leverage position in SNDK. Shares crashed all the way down to a low of $1,012. But just as the entire sector was about to implode, Citadel stepped in, swallowed the fund's massive block of shares, and single-handedly stabilized the market. But could a single earnings report undo all of that stability? The real test came on August 5th, when SanDisk released its highly anticipated earnings, sparking a massive battle between retail panic and institutional accumulation. On August 5th, SanDisk dropped what can only be described as a financial masterclass. Fourth quarter revenues skyrocketed 372% year-over-year to $8.97 billion. GAAP net income hit a staggering $6.9 billion, which translated to a diluted earnings per share of $43.97. Their data center segment alone grew a mind-blowing 103% sequentially to $2.97 billion, proving that hyperscalers are absolutely ravenous for their chips. So why did the stock drop 9% after hours? Because momentum traders panicked over next quarter's revenue guidance midpoint of $10.55 billion, which came in just a hair below the whisper numbers. They completely missed the forest for the trees, ignoring a blowout year that brought in $20.25 billion in total revenue. And while short-term traders were busy panic selling the news, SanDisk's engineering team was quietly preparing a technological breakthrough that would completely change the competitive landscape. To understand why SanDisk has a death grip on the AI storage market, you first have to understand the AI memory wall. Modern AI GPUs are incredibly fast, but they are constantly being throttled because traditional storage simply cannot feed them data fast enough. On August 12th, SanDisk and its partner Kioxia shattered this bottleneck by unveiling their 9th-generation 2 TB QLC 3D NAND flash technology. This chip features an interface speed of 4.8 gigabits per second, which is 33% faster than anything else currently on the market. And this is not just a minor upgrade. This is a massive technological moat that makes SanDisk the absolute default choice for low-latency AI data centers around the globe. But technological superiority is completely meaningless without commercial execution, and that brings us to the most defensive metrics sitting on their entire balance sheet. At their Investor Day on August 13th, management dropped a bombshell that completely de-risked this stock for long-term investors. They disclosed 8 multi-year fixed-price contracts spread across 6 major hyperscale clients. These contracts guarantee a minimum revenue floor of $93.9 billion over the next 4+ years. Let me put that into perspective for you. SanDisk has already secured 50% of its bit volumes for 2027 and 2/3 of its bit volumes for 2028. So could a sudden drop in memory prices destroy their revenue like it used to? That risk is now officially gone. The cyclical discount is dead, and the market simply has not priced this in yet. Now, what does a company with high margins and a guaranteed $93 billion revenue floor actually do with all of that cash? They build an absolute compounding machine. Because SanDisk operates at a stunning 50% adjusted free cash flow margin, they generated over $5 billion in free cash flow just this past quarter alone. And remember, their policy is to return 100% of excess cash back to shareholders. To back this up, the board just added $14 billion to their stock buyback program, bringing their immediate buyback capacity to $15.5 billion. Top analysts like Ben Reitzes over at Melius Research point out that over the next few years, SanDisk has the mathematical potential to buy back up to $100 billion of its own stock. Just think about that for a second. That creates an unstoppable, self-reinforcing, compounding engine for earnings per share growth. When you combine a massive buyback engine like that with $93 billion in contracted revenue, Wall Street analysts have no choice but to dramatically rewrite their price targets. Let's look at the heavy hitters. Following Investor Day, we saw a wave of massive upgrades flood in. Argus Research upgraded the stock to buy with a $1,600 target. JP Morgan's star analyst Harlan Sur reinstated coverage with an overweight rating and a $2,250 target, and the targets get even wilder from there. Amit Daryanani is sitting at $2,800, Susquehanna is at $3,250, and Melius is leading the entire street with an astronomical $3,600 price target. With the stock currently consolidating around $1,596, even the most conservative of these targets represents a massive upside from current levels. But don't just blindly follow the analysts. To really see where the smart money is actually placing its bets, we have to follow the institutional flows. The institutional smart money is aggressively buying this dip. Over 1,100 institutional investors added SNDK to their portfolios last quarter, while only 400 reduced their exposure. Goldman Sachs increased its position by a staggering 210%, and Jane Street disclosed a massive 7.41 million share stake, giving them a full 5% beneficial ownership of the company. But the most explosive data point of all lives in the derivatives market. SNDK perpetual futures have become the single largest equity perpetual trade on the entire planet, pulling in $2.51 billion in daily volume. That is nearly 8 times the volume of Micron. This heavy leverage creates what quant traders love to call coiled momentum, where any upward move forces market makers to buy shares to hedge their positions, which in turn triggers a powerful gamma squeeze. So just how close are we to triggering that coiled spring? To find out, we have to look at the immediate gravity map of the options chain. Let's look at the options expiring on August 28th. We see a massive concentration of put options sitting at the $1,500 strike, which represents a very firm, market-supported psychological floor. On the upside, we have a major battleground of call options at $1,750 and $1,800. But look at this outlier right here. There is a towering peak of open interest sitting at the $2,000 call strike. This massive cluster acts like a financial magnet, literally pulling the price upward as market makers scramble to hedge. Meanwhile, the short sellers are completely and utterly trapped. Short interest fell 13% last month to just 4.62% of the float, with a days-to-cover ratio of only 0.4. So if the price starts to run, is there any liquidity left for the bears to escape? The answer is basically zero. So where does the chart actually tell us this stock is heading next? Let's lay out the exact technical blueprint. On the daily chart, SanDisk is carving out a textbook bullish flag pattern after breaking clean out of its descending channel. The stock is currently trading 71.4% above its 200-day moving average, which confirms an incredibly strong long-term uptrend. For next week, our near-term breakout support sits right at $1,581, with secondary support at $1,485, which lines up perfectly with the key moving averages. On the resistance side, we have near-term resistance at $1,695, followed by psychological and Fibonacci resistance sitting between $1,787 and $1,830. If we break above $1,695 on high volume, expect a violent, fast move toward that $1,800 zone. With all of this fundamental, quantitative, and technical data now in hand, how do you actually go about trading this stock? Here is your step-by-step playbook. No matter what your personal risk tolerance is, there is a clear way to play this setup. For long-term investors, your strategy is beautifully simple. Accumulate shares on any weakness between $1,420 and $1,550, and then hold through the decade to let those compounding share buybacks do all of the heavy lifting for you. For short-term swing traders, your play is to buy the dip near the $1,580 support or buy the momentum breakout on a daily close above $1,695. Just make sure you set a strict stop loss below $1,480 and then ride the momentum all the way back toward $1,943. But what if you are a more conservative investor who wants to generate high yields while setting up a massive safety net at the same time? Well, there is an options strategy designed just for you. If you want to own SanDisk but you also want an extra layer of safety, take a close look at the Trefis cash-secured put strategy. You can sell put options expiring on September 17, 2027, with a strike price of $710. Doing this allows you to immediately pocket a premium of roughly $8,085 per contract. This gives you a 10.5% annualized yield on your collateral. And here's where it gets interesting. If you park that cash in a money market account earning 5%, your total annualized yield actually rises to 15.5%. If the stock stays high, you simply keep the cash. But if it crashes, you get assigned the shares at $710, which, after subtracting your premium, gives you an effective entry price of just $629. That is a massive 60% discount to current market prices. So whether you decide to use options, swing trade, or simply buy and hold, the ultimate conclusion on SanDisk remains exactly the same.
Mal.
Now, before we get to that final verdict, I do need to share a quick and important disclaimer. Everything discussed in this video is for educational and informational purposes only, and it should never be taken as financial advice. I am not a licensed financial advisor, and these are simply my own opinions based on publicly available data. Investing in the stock market carries real risk, and you can lose money. Price targets, analyst ratings, and projections are never guaranteed to come true. Please always do your own thorough research and consult with a qualified financial professional before making any investment decisions with your own money. With that out of the way, the final verdict is crystal clear. Based on the data we have covered, SanDisk looks like a compelling buy-the-dip candidate at these levels. The company has successfully built a high-margin, predictable AI utility business, but the stock market is still stubbornly pricing it like a volatile commodity hardware maker. This is a rare structural valuation disconnect, where the price has simply not caught up to the underlying math. The leverage has been flushed out, the institutions are loading up, and the technology is completely unchallenged. Don't let the short-term volatility distract you from the fundamentals. So now I want to hear from you. If SanDisk really does have a $93 billion revenue floor locked in, why do you think Wall Street is still valuing it at a fraction of its peers? Drop your honest take in the comments below. I read every single one, and I would genuinely love to hear whether you are buying, selling, or holding SNDK right now. If you got value out of this deep dive, please smash that like button and subscribe to the channel so you never miss our next analysis. Thank you so much for watching, and I will see you in the next one.